Hi, welcome back to Conarchy's Money Corner, my YouTube channel teaching you how to handle your money decisions financially and not emotionally. Do you know that the government makes you pay an upfront tax? A surcharge when you obtain a home mortgage? Unfortunately, it's true. And worse yet, that tax surcharge has been increased not once, but twice in the last 4 months. Yes, the federal agency FHFA, that is the Federal Housing Finance Agency, which was created in 2008 to oversee and regulate the government-sponsored mortgage enterprises of Fannie Mae and Freddie Mac, announced a big upfront surcharge increase in November of 2022, and if that wasn't enough, right away announced another additional upfront surcharge increase in January of 2023. This upfront tax, surcharge, is called a loan level price adjustment, and you pay it when you obtain a mortgage from Fannie Mae or Freddie Mac. Now, over 60% of all mortgages originated in this country go to those two government-sponsored enterprises. They are by far the number one and number two sources of mortgages. So this will affect so many. So let me articulate with you what this all means. After November's increase, if you're buying a $500,000 home and putting 20% down, therefore borrowing a $400,000 loan amount, Fannie Mae and Freddie Mac currently charge you an upfront surcharge of 0.5%, which is $2,000 in that example. Now, this assumes that you have a mid-credit score of 740. Now, with the surcharge increase that happened in January, you'll now be charged 0.875% or $3,500. This is a staggering 75% increase of that surcharge that the government is charging you. And if your credit score is lower than 740, that will result in even higher upfront surcharge. So 2 things that I wanted to let you know with this week's video. 1, that these government upfront surcharges exist when you obtain a mortgage. And 2, that these upfront surcharges are going up again. Now, and maybe the most important part of this video, what do I recommend that you do about this? If you're currently looking to get a mortgage, I strongly recommend that you work with a mortgage professional that is going to do the math for you. Looking at these upfront surcharges and seeing what's best for you for your financial situation. What's the best financial option? Well, what do I mean by this? First, let me explain that there's a way that you can avoid paying these upfront surcharges. Like all upfront charges, your mortgage lender that you work with has the ability to raise the mortgage interest rate that you get and therefore avoid having you pay upfront charges. Sometimes this is referred to as building upfront charges into the interest rate. So you have a choice here, and you need to know this, to pay the big upfront non-refundable charge or no upfront charge in exchange for a slightly higher monthly mortgage payment. Remember, when paying the upfront charges, it is an irrevocable decision. Once you pay that upfront surcharge, it's gone, non-refundable, never to be seen again, and you can't get a do-over. Many consumers make this mistake of focusing solely on the mortgage interest rate when obtaining a mortgage. But I caution you when you're doing that. While the lower interest rate feels intoxicating, the higher non-refundable upfront charges can actually cost you more than a higher interest rate without those upfront charges. How? I'll explain it. Assume that rate on that $400,000 loan amount is 6.5% that you're paying the $3,500 upfront surcharge for. Your mortgage principal and interest payment at 6.5% is $2,528 a month. But not choosing to pay the $3,500 surcharge up front instead and building that surcharge into the interest rate, the rate would be 7% and your mortgage principal and interest payment would be $2,661 a month. So $133 more a month, but you're avoiding the $3,500 upfront surcharge. So this is where you have to do the math to make sure we're making the best financial decision. Do you pay $3,500 up front to save $133 a month? Doing the math on that, it will take you 26 months, over 2 years, to recoup your upfront $3,500. So you have to be in that mortgage longer than 26 months just to break even. And notice I said in the mortgage, not in the house. Because what if mortgage rates fall in the next 26 months, as many economists are predicting? They believe that after the Federal Reserve's inflation slowing economy, we may head into a recession and interest rates will fall. So if interest rates fall in the next 26 months and you refinance to a lower interest rate than the $3,500 that you paid up front, you lost money. You didn't recoup your $3,500 that you had paid up front. This is why focusing solely on the mortgage rate alone and not taking into account the upfront non-refundable charges, that can be a big financial mistake. And unfortunately, I see consumers make this mistake often when they're obtaining a mortgage. That singular focus on interest rate will be an even bigger mistake with this upcoming increase in those upfront surcharges. See, I said it right that time. So in summary, be aware that these government upfront mortgage surcharges exist. Work with a mortgage professional that will compare paying upfront surcharges versus building those surcharges into your interest rate or into your payment. And find a mortgage professional that has specific software that tracks your new mortgage minute by minute and alerts you automatically in real time to refinance when mortgage interest rates fall below the initial interest rate that you received. And for the record, I do all of the above. If you have any questions, as always, if you have any questions or comments, please leave them in this YouTube's video comments section. And as always, feel free to contact me directly if you have any specific questions regarding how all this affects your personal situation. As you know, I'm always happy to help. And please don't forget, subscribe and like my Conarchy's Money Corners videos, including this one. And most importantly, I look forward to talking to you again next time on Conarchy's Money Corner. Talk to you soon.